April the 11th. Michael Vaughn with Brian Acker. Brian, the first quarter's in. How'd we do?
Canada came in around 5%, 5.3, and the benchmark came in at 4.3, so a percent above.
Yep.
Yep. The U.S. we came in at 9.7, and Canadian dollars in the U.S. We're just a little below 90 beeps. The index in Canadian dollars was a 10.6.
And the American market was stronger. Whenever there's a strong market, you outperform.
It is, but probably in the last month we got a little bit more conservative with the portfolio than we usually might have. So.
Well, I remember you put out a blog in February anticipating a correction. Mm-hmm. And lo and behold, we have the correction.
We're probably just starting one. So. And actually, got to thank the market because it waited till April. I mean, what we worried about was worrying the quarter. So the market does, help every now and again. But no, we thought it would happen probably the latter part of March. So we're off by a couple weeks.
When you see it coming, though, what can you do? What can you do?
Well, in both portfolios,
because you don't go to cash.
We haven't, certainly in the past, but each portfolio now is about 5% cash.
Oh, that's more than usual.
Yeah, so that's quite liberal for us. And the second thing we can do is when we look at when we break down, let's say the S&P 500, we can break it down into deciles. In other words, 50 companies upside to model price. Yeah. And what we can do. I mean, in most normal market times, you want to be in decile 1. Most upside.
Would be the most upside.
The most upside.
Probably the most volatile.
Very volatile. But you're paid for that volatility.
Right.
In terms of your returns. So what we have done in the past, the last certainly 2 years, and when we see occasions like this, we just tend to make selections in decile 3, decile 4, decile 5.
Oh, I see.
Less volatility.
Yeah.
And you still get the returns, but the variability or the volatility gets reduced somewhat. So
that is rational. But is this a correction, or is this the market signaling recession? Is this double dip coming?
Almost Groundhog Day from last year.
Yeah. Well, we're up 10% at one point last year.
Yeah, same as this year.
Yeah.
It's amazing. No, I think the market gets paranoid, obviously, at certain periods of time, and we're still in a very difficult time. There's no question about that. The issue becomes, I think, I don't think we go into a double dip recession. This is an election year. Certainly the Fed will be accommodative. Certainly Europe. The ECB has changed its tune. It's becoming more accommodative. So, I mean, there shouldn't be one, but, growth at 2.5% is not that much it's good that it's growing, but it's not as much as what you want. In other words, you want a little safety growth if there was a hit of something like a terrorist attack or.
But the good companies in the S&P are doing much better than 2.5%.
Absolutely. So, I mean, why be in equities?
I wish we'd get paid for that.
Yeah, but they're holding on to their cash dollars.
Yeah.
So, we calculate a year from now, when you look at the book value of the S&P, less dividends. I mean, the dividends you get. I mean, we'll be up 18%.
Wow.
In terms of that book value, if you look at the company's
strengthening of the balance sheet,
it's all retained earnings. The earnings coming in on the retained earnings, so those balance sheets are growing, less the dividends they pay out, and you're left with 18%. So that's your base case.
Gotcha.
So there will be corrections. There will be some pauses in the market, but you've got an 18% biased upward in terms of these companies growing. So.
Gotta like that. But the election year rally is not a gimme this time.
I think it is.
Oh.
It just may happen in October, December. I mean, November, December.
Oh,
I mean,
the
election's the first week, first Tuesday in November, and that leaves 2 months. And actually, I think it happened 3 or 4 years ago. All the return was in the last
Yeah.
2 months, and that could very well happen again this year. So.
Well, I'm glad we got the first quarter put to bed in nice terms. I'll be in to see you in the month of May. Thanks for your time.
Great to see you again, Michael.